at a Metropole TVKA across all your social media platforms. My name is Simba Elijah Charles here again. Thank you very much for choosing to begin your day with us here at a Metropole Television. If you're just joining us, this is a Business I Am online hashtag Business I Am. I am at Kiange Simba. Let's have that conversation going on. All right, just before I introduce the guests who are joining us this morning for this last part of our review, let me jump into two banks that have given us the results again this week, and that's how we close this week. Let me jump into NCBA and Equity Bank, and we're going to look at the highlights for financial year 2021. Fantastic. Richie, if you could jump into NCBA, fantastic. Good. So now, when we look at this, then you will see exactly how the results have been. So from here, we have the assets for NCBA jumping 591 billion, digital loans 584, customer deposits 470, and that's in billions. Operating income 49B, and the group profit after tax 10.2 billion. Fantastic. Let's jump on to equity. Another big boy that has given us the results this week. If we look at our profit after tax, 40 billion, and net loans and advances 587.8 billion, customer deposits 959 billion, and then the big one in terms of that asset, they jumped the 1 trillion valuation in 2020, and we do know why, because from 2018 up to 2020 they are not really giving out their dividends, and that really pushed them into the 1 trillion asset valuation. But then even after they declared the dividends this time, you can actually say that indeed the balance sheet was 1.3 trillion. Now, conversation point is especially on this is their profit after tax trend, and we can see exactly where they are in a 2021, that 40.7, representing a 99% increase in that profitability from where they were in a 2021 at a 10.9%. That if you look at where they were in 2020, then that change was at negative 10.9% in terms of that profitability trend. Fantastic. Now, this week, because then indeed we want to close this conversation for the banking quarters at the NSA. Let me introduce the guests that are joining us this morning for this conversation. We do have Justin Mwangi, who's an investment analyst. Justin, good morning, sir.
Good morning, Simba. Thanks for having me today.
Anytime. We also do have Said Shah, who's a lawyer and associate at Bowman's Kenya. Said, good morning, sir.
Morning, Simba. How are you?
Fantastic. It's been a minute. Should I be saying Happy New Year?
I think it's a bit late for that, yes, but we haven't met in a while. Happy New Year.
Never late, man. Never late, man. All right, lastly, we do have Rufus Kamau, who's a research and markets analyst at Scope Markets. Rufus, good morning, sir.
Morning, Simba.
Fantastic. We're happy to have you around. Good. Now, let me then introduce this topic where Equity Group has recorded incredible performance for the year ended at 31st December 2021, despite the challenging operating environment characterized by a global COVID-19 pandemic. Now, profit after tax increased by 99% to 40.1 billion from a 20.1 billion, with a profit before tax recording a growth of 134% to 51.9 billion, up from 22.2 billion the previous year. Now, the group has recommended a record dividend payout of 3 shillings per share, totaling to 11.3 billion, which is a 50% jump from the previous dividend payout, after earnings per share grew by 98% to 10.4 billion, up from 5.2 billion the previous year. Fantastic. Let's continue. Now, despite zero rating mobile transaction offerings, transaction income grew by 37% to 10.4 billion, up from 7.6 billion on the back of e-commerce and the merchant banking services. Another interesting in the income sheet was foreign exchange trading income grew by 33% to 8.3 billion, up from 6.2 billion, driven by diaspora inflows that grew 37% to reach 383.5 billion, up from 279.4 4 billion. Now, on the back of the improved performance, Equity Group Board proposed a dividend payout increase of 50% up to 11.8 billion or 3 shillings per share, which will be the first time shareholders will be getting a dividend after 2018. Now, we do know the lender has cancelled that dividend twice. Now, the group's balance sheet size grew from 1.015 trillion in 2020 to 1.35 trillion in 2021, which is a growth of 29%. Now, Equities Group's profitability as a measured earnings per share, that is the EPS, grew 98% to 10.4 in 2021 from 5.2 in 2020, with net loans and customer deposits also increasing 447.8 billion to 587.8 billion as at the end of 2021. Fantastic. That is Equity in a nutshell. Justin, let me begin with you, and I'll give you another concern that I'm getting from time to time, that indeed when we are talking about the profitability of these banks now in 2021, that this will not be an organic growth, knowing very well that there's one thing that is striking in their balance sheet, that provisions for non-performing and bad loans as well has gone down drastically across the board. So indeed, we should be talking about this growth with a pinch of salt. Is that the same thing that we should be looking at this result for Equity?
Sure, Simba. But also, even if you remove provisions, we're still seeing some growth in most of the big banks. But
yes,
most of the profits, or the large growth we are seeing in profits, is due to the massive reduction in terms of loan loss provisions.
Yes.
Equities increased by 78% thereabouts. So, of course, if that were not the case, then the profits would have maybe increased by 2 or 3 billion. Only. So for sure, there's a bit of inorganic growth, especially look at banks like Equity, which are also expanding regionally.
Yes.
And some of the growth attributable to their subsidiaries, especially in comparison to 2020 and 2019. But overall, it's a good thing that these banks are now getting to this recovery period. They're not over provisioning to high amounts. That just shows where we've come from as countries and nations, the operating environment in Kenya.
Pretty much. Justin, I'll be coming back to you, because then indeed we need to look at exactly where this growth for Equity has come from, and there's that inevitable comparison that we have to do with KCB as well, because we do know they've officially joined that 1 trillion asset valuation mark. It's fine, we'll be coming to that. Let's also talk, let me bring you in, Sid, on that as well. I mean, from you, when you look at the way in which Equity has grown, I mean, there are talking points that you can look at. Indeed, you can say that indeed they've reduced those loan provisions that are down 78%, just like Justin is saying. In fact, from 26 billion to 5.8 billion. Then what they've done is that they've increased lending to the government, and that has grown 81% year on year, which now stands at 391.4 billion. For you, Sid, would you call this growth organic if indeed you take out that massive reduction in loan provisions?
Thanks, Simba. Before I answer that, we must remember something, that banks have gone through a tough phase from the start of the pandemic in 2020.
Yes.
And profits were really affected. Central bank had issued advisories to banks requesting them not to issue dividends, just to ensure capital reserves remain robust for them to continue with their operations. So if you look at that, and then when we come into 2022, I mean the 2021 financial year, there's a lot that has been going on. I mean, businesses have recovered. There's been a spur in economic growth. The recovery of activity has helped unlock that had otherwise, been frozen or renegotiated. So, in a sense, you can say to an extent that it is organic. And when a bank's, bad loans provisions,
yes,
dropped significantly, as Justin said, 78 to 80%. I mean, that is signs of good hope for the economy and for the banking sector on its own. And as you've correctly pointed out in the statistics, I mean, the government has been looking into the private market, the private domestic market for borrowing, and are expected to be borrowing close to 600, approximately 600 billion by June of this year. So that's also a big growth, for banks in terms of the income generation.
Yes.
And we also must remember that there's been a growth in investment of government securities. I mean, if you look at equities performance, 81 there's been an 80 close to 81% growth in investment of government securities and income derived from that. And also non-funded income has grown significantly, and there's been a growth of the loan book by close to 23%. When you look at all these numbers, I mean, it does give us a sense that, in as much as people may argue that it is not organic growth, that there has been organic growth. The banking sector is being resilient to the ongoing pandemic, and that on its own is a good indicator for the country going forward.
Yes. Fantastic. Rufus, let me also get you in on this as well. The conversation of whether indeed this is organic growth or we should really separate the results for 2021. And some analysts are saying if you really want to compare this growth, then you have to compare 2019 with the growth for 2021. And that's when you're going to see exactly what the growth or the performance of this banking industry has been. Rufus, do you agree indeed that when you have this sort of growth, and I'd like to throw some data onto your table this morning. I mean, look at where we are. Even on a gross non-performing loans for equity group holdings, they've declined from 59.39 billion in 2020 to 53.86 billion. And if you look at that gross NPL ratio decline, it's actually now at 11%. Actually was at 11% in 2020 to 8.3% in 2021. We do know the industry average, Bufas, was around 13.6% in 2021 before it came back in quarter 3 of 2021, before it came back to 14% again. But when you look at these numbers that equity is giving us, would you say that the growth has been generic for a lender that has never given us dividends for 2 years now in a row?
Thank you very much, Simba, for the question. Looking at the performance of the banking sector with a bigger view, we would say that yes, it was impressive. This year we saw some good numbers. But if you really look into the numbers and then you try and segment the numbers, so when you have a big number, this is the profit that the banking sector made. You break it down, then you realize that there's a good chunk that is coming from loan provisions. So loan provisions is basically money that had been made in 2020. The money was put in a shelf to cover for non-performing loans, but since it was not used, then it was added as income in this year's reporting.
Yes.
So we cannot say that it's a good performance that happened last year. We know it's an accounting activity that really led to the performance. But now if you break down the other data, then you realize that there is a big growth in mobile banking. And this, in this case, I would say is organic growth. There's a big shift. A lot of Kenyans are no longer going to the banking halls. Now they are doing their banking activities from their comfort of their mobile. So yes, this is organic growth. At the same time, we have seen the transition. We are trying to do away with checks. And I believe this is an approach that banks are trying to use so that they can cut their costs. So without checks, then a lot of participants in the market will be forced to be using the mobile banking, which is already existing infrastructure. So I expect this kind of growth to continue rising. So at the same time, when you look at the mobile transactions and also mobile loans, they have been on the increase. So with the NCBA, we have seen some good growth. I believe ABSA was the one that surprised the market with their Timiza product. They were able to make some good returns from that. And we are hoping that this kind of growth will continue. even though there's two major factors to consider as we go forward. So the general elections coming up in August, at the same time the Russia-Ukraine war, big concern. So this could hamper growth going into 2022.
Yes, fantastic. Justin, let me get back to you then, because specifically on this performance for Equity Group, now we don't, if just looking at the results that they've given us for this financial year ended 31st December 2021, then you would be justified to call them the most profitable lender in 2021. Fine, just going by their numbers. But then when we consider that this is a lender that has not really declared dividends for 2 straight financial years, would you then start to say maybe this growth has been heavily dependent on what they've been able to do? Number one, do not declare dividends, get to reinvest that money back, and they had the leeway, and you could see that for Equity Group. I mean, they told us that indeed they were able to actually provision for more than 32% of the customer's loan book. When you look at that, they had the leeway to do that because then they hadn't declared dividends. Others were able to declare, some of them. I mean, I'm talking about the tier 1 banks. So when you look at this growth for Equity Bank, where would you put it going by these numbers that I'm giving you this morning, Justin?
That's a very interesting. Those are very interesting figures, Simba. What we have seen Equity do over the last couple of years is being very conservative.
Yes.
In that, when they're making money, especially in 2019, they didn't declare dividend, but that was because they were entering the DRC market.
Yes.
In 2020, of course, they were a bit more conservative than the rest because they figured there might be high NPL, so they had to increase their Tier 2 capital. So they didn't pay any dividend whatsoever.
Yes.
However, we expected maybe in 2021 we may get half one, a bit of interim dividend. That didn't happen as well. So we have seen Equity holding on to its funds a bit more than what we expected. But if you look at it long term, especially from a shareholder point of view, this is not a stock that ideally you expect very high dividend yield from.
Yes.
But because of those activities, it can't go more than a month without hearing something that the Equity Group has done. So in as much as they have held on to some of the cash in the past, they're using this in revenue to diversify and grow their revenue through other businesses. So for example, the insurance agency, for example, just putting in more money into their subsidiaries. So we expect that in the long term, then you can at least expect a bit more capital appreciation, especially in the share price of this bank. But dividend yield still remain a bit lower than what you'd expect from the other markets.
Pretty much. Justin, were you expecting for them to pay out more than they did? Because indeed they did promise. This is a bank that has not paid dividends for those 2 years, and it's not like they were not profitable they were profitable within those 2 years. Just that their profit margins did reduce. So you would say that whatever they were trying to do in terms of holding back on that cash and reinvesting it was working. Were you expecting that the dividend payout that they're going to do this time, as of 31st December 2021, could have been more? Because they actually promised that they weren't even looking up to ratios of 50%. But this time around, they came back to 28%, even lesser than they had said, the 30%.
Not really. In-house, our view was the dividend probably come at in about 2.5 shillings.
Yes.
So when they declared 3 shillings, it was slightly more than what we expected. The thing is, if you haven't paid dividends for the last 2 years, then you wouldn't, when you're going back to start paying dividends, you won't drastically pay 5 shillings, go to 10-20% dividend yield. And remember, this is a bank that, in as much as it's not diversifying as much right now. It has already done that over the last 2 years. If you look at some of the other ratios like core capital to risk-weighted assets, it has taken on a lot of loans from their diversification. So they need some of that capital internally just to be able to provide that buffer in terms of anything. So the 3 shilling was, I would say, within the range of our expectation.
Yes.
In-house, slightly more than what we expected.
Pretty much. Now, Sid, On the other hand, NCBA Group saw its earnings for the year double the financial year ended 31st December 2021 to 10.2 billion from 4.6 billion posted over a similar period in 2020, which represented an increase of 121.7%. Now, the lender leveraged the digital loans highly for the financial year 2021 as they jumped to 584 billion in 2021 from 434 billion in 2020. Now, NCBA's total operating income increased to 49 billion in 2021 from 46 billion in 2020, with operating expenses declining to 33.4 billion in 2021 from 40 billion in 2020, with its balance sheet growing to 591 billion in 2021 from 528 billion in 2020. Customer deposits recorded a growth to 470 billion from 422 billion in 2020. However, this is where the conversation point comes from, and Sid, that's what I want to ask you this question from. Net loans and advances to customers declined to 244 billion in 2021 from 248.5 billion in 2020, with total interest income also increasing to 46.5 billion from 44.2 billion in the prior year. Sid, when you have this sort of performance, the bank is telling you now, if you look at the most profitable lenders now, you'll be saying NCBA will take that position 3. Fine. But then if you come back to this and then look at net loans and advances to customers reducing 1.8%, a time that if you compare across the board, majority of the lenders, this was on the positive. How do we interpret this result for NCBA vis-a-vis that reducing margin for net loans and advances to customers?
Thanks, Simba. And I think it's correct to say that because net loans and advances, it takes up a huge portion of a bank's income.
Yes.
So when you see a decline in that, I mean, there are question marks, and one would wonder what exactly has gone on here. But if you look at the difference from 2021, of 4 billion. At the same time, the bank has managed to reduce its expenses by approximately 7 billion. So, I mean, there's a balancing effect that kind of goes on there and ensures that, you know, the overall net profit still remain significantly higher.
Yes.
And also, you know, income being generated through other means. I mean, interest income has increased. Income from foreign exchange, income from government securities, an increase in those has had that balancing effect to cater against that, a reduction in net loans and advances. And it could be a reason, and this is just purely something from my thinking and not based on any fact, but it could be a reason, just the growth in trade and the lifting of the interest rate caps in 2019.
Yes.
May have had a possible impact on the reduction in these net loans and advances. But I don't think that in its own is an indicator that would justify a bank's position. I mean, it's an accumulation of all these financials that would justify a bank's position or ranking in its sector. So based off that, I don't think it's something to really scrutinize that much. But I would leave that to the economic analysts, Justin and the likes, for them to actually help dissect this and help us understand why or the reasons as to why net loans and advances have reduced and what impact that would have on the financial position for NCBA.
Pretty much. I'll be coming to Justin on that. And Rufus, I want to take a minute as well and look at those digital loans that NCBA is talking about. They've increased drastically as well. I mean, if you look at that 584 billion. I mean, even close to their entire asset valuation for the financial year 2021 is an area that the NCBA has really got into. And how can you link this to what is going on in the economy right now, Rufus?
So thank you, Simba. When you look at the mobile lending and the kind of path that we've been following over the past couple of months,
Yes.
first of all, there's a gap. We know that there was a lack of liquidity during the COVID-19 pandemic, and a lot of Kenyans were forced to borrow or depend on SACCOs, as well as these other unregulated mobile lenders that often come with very high interest rates.
Yes.
So the uptake of mobile lending from mainstream commercial banks has been very positive. It has been filling a gap that was very much needed. A lot of people needed liquidity to bootstrap their businesses and basically just go back to activity. So during 2020 through to 2021, there was a lot of challenges. Banks were providing more of their money to bonds, that is government bonds, since they were deemed to have lower risk but a very good income.
Yes.
When it comes to the uptake, since we lowered the COVID-19 restrictions, and that was late last year, we have seen some good growth in mobile lending, and we are hoping that these will continue. So I believe this is a function of expectations. So when people are expecting that the economy is going to boom and expand over the next couple of months, then they are more comfortable taking even more loans to bootstrap their businesses. So the fact that these loans are rising, I believe it's an indicator that people are very positive about the Kenyan economy over the next couple of months.
Yes.
So if I felt that things would really go bad, let's say towards August, then I would definitely scale down my business activity and reduce the amount of loans that I'm taking from the banks.
Yes.
So this is a positive thing for us right now.
Pretty much. Justin, I would like us to go for a tiny little break. But once we come back, I mean, the question is going to be, I would like to take a minute then to look at NCBA. And if we do know very well, I mean, we got to look at that because we do know there are a lot of big boys in that tier one category. A couple of changes that we've seen that started in 2020. Equity, once they got into that 1 trillion valuation mark, they look like they are there. And if you look at their profit margins, they're way beyond what KCB is bringing now. They were rated #1 most profitable lender in 2021. NCBA has knocked off Cooperative Bank off position 3. I'll be asking you whether this is now the trend that we should be expecting, or this is just in 2021, and your quick sentiments on why NCBA's net loans and advances to customers dipped, but their profitability stood up as well. Once we come back here on a Business AM, my name is Elijah Charles here.